Something just happened that most people will not understand until the price of understanding is much higher. They will call it a gold move, they will call it an oil story, they will call it a bond market problem, they will call it inflation, they will call it war. All of those labels will sound intelligent, and all of them will miss the deeper truth. What actually happened is much simpler and much more dangerous. The math holding the monetary system together developed a crack, and money always runs through the crack in the same order. That is the whole game. When I say the same order, I do not mean the same headlines. Headlines are costumes. I mean the same monetary sequence, the same pressure release, the same migration from paper confidence into things that either cannot be printed, cannot be diluted, or get repriced when the currency itself starts losing credibility. People love to act as though each crisis arrives from another planet. They say this time is different because they want to feel like history is a museum and they are living in a civilization drama. I have been around markets long enough to know that human beings repeat themselves with alarming loyalty. The names change, the slogans change, the politicians change, the maps on television change, but the way fear moves through the financial system is remarkably stable. That stability is your advantage, if you know how to read it. The first thing you have to understand is that a crack in the system does not begin where the public thinks it begins. The public thinks it begins at the point of pain they can see. Gasoline prices, mortgage rates, stock volatility, food inflation, central bank panic. That is where they feel it. That is not where it starts. It starts where confidence in the denominator begins to weaken. The denominator in a monetary system is money itself, not the speech, not the excuse, not the official narrative, the money. And the first asset that tends to notice that crack is usually gold. That surprises people because they think gold is supposed to go up neatly every time the world becomes unstable. In their mind, instability means fear. Fear means safe haven, and safe haven means a straight line higher. Real markets are far less polite than that. In the early phase of a real stress event, gold often does something that embarrasses superficial thinkers. It drops, sometimes hard, sometimes violent, sometimes enough to convince perfectly rational people that the thesis is dead. That is when the signal becomes interesting. A gold collapse during a major crisis is not always a contradiction. Sometimes it is the opening act of the whole sequence. Why? Because in the first scramble for liquidity, people do not sell what they hate. They sell what they can. They sell what is liquid. They sell what can raise cash right now. Gold gets sold, not because the monetary thesis disappears, but because participants are stampeding for temporary funding. They do not want gold less. They need dollars more. They sell the fire extinguisher to buy 20 more seconds of oxygen. That liquidation phase looks like failure to amateurs. To me, it looks like the smoke detector starting to ring. And every time that kind of move has happened during a real systemic stress event, what followed was not some cute little bounce. What followed was a repricing sequence that moved across every major asset class in order. That order matters more than the event itself. The event is just the match. The order tells you where the fire will travel. Now let me explain why the sequence starts running in the first place. You can dress the current moment up any way you like, but the core problem is oil and debt meeting each other at exactly the wrong moment. Before the recent conflict escalated, an enormous amount of the world's oil moved through one choke point. Then disruption entered that pipe. Replacement flows appeared, but not enough. Emergency barrels help, but they do not erase the shortfall. Temporary inventory helps, but temporary is not the same thing as solved. That means the world is suddenly trying to live on less usable energy than it thought it had. Energy is not just another line item in the economy. Energy is the hidden tax inside everything. Diesel moves food. Jet fuel moves people and packages. Natural gas powers industrial activity. Oil is inside transport, logistics, production, chemicals, plastics, agriculture, and all the things people want to pretend are separate from energy until the bill arrives. A serious oil shortfall is not one problem. It is a pressure multiplier. So the first thing the system experiences is an energy shock. Then the second problem appears. Governments that are already fiscally stretched do not meet that energy shock from a position of strength. They meet it from a position of arithmetic weakness. And that is the part most people never study because it sounds boring right up until it becomes the only thing that matters. A government can survive an external shock much more gracefully if it has spare room in the budget. If tax receipts exceed essential obligations by a healthy margin, then temporary disruption is unpleasant but manageable. But when a government is already spending more on unavoidable commitments than it takes in through taxes, then the system loses flexibility before the recession even begins. That is where the crack becomes structural. Imagine a household where the mortgage, the electricity, the car payment, and the health insurance already exceed the paycheck before food enters the conversation. At that point, life is no longer about budgeting. It is about financing. Every extra problem goes on a credit card because there is no spare room in current cash flow. That is what a fiscally overextended government looks like when crisis arrives. It is not choosing among good options. It is choosing which kind of damage arrives first. And when recession pressure starts building on top of that, tax revenue weakens exactly when the obligations become heavier. That is when the people running the system reach the same ugly three-door hallway they always reach. Door 1 is austerity. Door 2 is printing. Door 3 is collapse. Politicians talk as though this is a difficult philosophical choice. It is not. They always walk through door 2, not because they are evil masterminds, because it is the only door that keeps the machinery operating in the short term. Printing is the political painkiller. It does not cure the disease. It buys time, which in government is often treated as success. The long-term bill gets worse, yes. The currency gets weaker, yes. The distortions compound, yes. But printing postpones the visible breakdown, and visible breakdown is the one thing governments fear more than long-term deterioration. That is why this sequence repeats. Once the system approaches the point where printing is the only politically survivable answer, money begins to migrate before the announcement. That is what Wave 1 is. Wave 1 is gold and broad commodities. It starts there because smart money is not waiting for the press conference. Central banks, sovereign allocators, commodity desks, and anyone who can read the government's balance sheet math sees the same thing. They see an energy shock hitting a fiscal structure that has already lost room to maneuver. They do not need official confirmation to understand what the likely response will be. They understand that if the denominator is about to be abused, the first refuge is something that cannot be printed. That is why gold is not the whole story. It is the signal. It tells you the crack has formed and the first capital is already moving. The second wave is the dollar itself. Right now, at the beginning of a crisis, the dollar can strengthen. That confuses many people. They hear the argument about monetary debasement and assume the currency should weaken immediately. But in the first panic phase, global participants are desperate for the medium in which obligations must be settled. Oil is priced in dollars. Debt is serviced in dollars. Emergency transactions demand dollars. So the first move can be a desperate scramble for the very thing that will later be devalued. This is not confidence. It is funding stress. That distinction matters. The dollar can rally in the rush for payment and still weaken later once the policy response arrives. In fact, that is often exactly what happens. The crisis creates temporary demand for dollars. The solution creates too many dollars. First comes the squeeze, then comes the release. Investors who cannot distinguish those two phases often mistake the first move for a permanent verdict. It is not. It is just one part of the sequence. Once the policy response begins, the dollar weakens because the machine keeping the system running requires more units of currency than before. That is what printing is. It is an admission that the problem will be carried through the denominator. Now, when the denominator weakens, Wave 3 begins. This is where hard assets and productive scarcity get repriced. Real estate, land commodity, producing businesses, energy infrastructure, mining assets, anything with real world scarcity and usable economic value begins to move differently because the money used to price those assets is losing quality. This is the mistake people make in inflationary transitions. They say the house became more valuable, or the land became more valuable, or the mine became more valuable, as though the asset itself magically changed character overnight. Sometimes the asset did improve, but often what really happened is that the currency measuring it became less trustworthy. The ruler shrank, so the table looked longer. That is an important mental shift. Hard assets do not always get smarter during these periods. The money gets dumber. And when the money gets dumber, scarcity commands a premium. This is why real estate, selected commodity producers, and other hard assets tend to participate powerfully in this wave. They are not just stores of value. Many of them also throw off cash flow. That creates a double advantage in a weakening currency environment. The asset base gets repriced while the income stream tied to it becomes more attractive relative to cash that is quietly losing purchasing power. Then comes wave 4. This is the liquidity wave into higher risk scarce assets and selected equities. Once the system has accepted that the printing response is the path, liquidity starts pushing outward. It first protects itself, then it starts hunting for upside. This is when the market stops merely asking, how do I survive debasement, and begins asking, where can I get paid the most for owning scarcity inside a digital, financialized world? That is where Bitcoin enters the conversation. I am not making a religious argument here. I do not need to pretend Bitcoin is perfect to understand why it belongs at the end of this sequence. It is fixed supply. It is natively digital. It is extremely liquid. It cannot be conjured into existence by a finance ministry. Assets with hard issuance constraints begin attracting a different class of money. That does not mean the path is smooth. Nothing in this sequence is smooth, but the logic is consistent. Then liquidity floods further out the risk curve into harder to replicate financial assets. That is the sequence. And here is the part that separates thoughtful investors from people who merely memorize narratives. You do not need to own everything in equal size at the same time. You need to understand where the sequence is now and where your current portfolio is blind. That is the practical question. Most portfolios built over the last 15 years were designed for a different world. Stable disinflation, manageable energy costs, benign currency assumptions, weak commodity cycles, long-duration assets rewarded. Growth stories valued at generous multiples because money was cheap and scarcity of actual cash flow seemed less important than the promise of future optionality. That environment trained people badly. It taught them to love assets that thrived in low inflation and a stable dollar, while ignoring what happens when the fiscal and monetary structure itself becomes the problem. So they built portfolios for slow, easy, orderly money. Then the world changed, and they kept the portfolio. That is dangerous. The biggest risk right now is not simply that markets fall. The biggest risk is being allocated for the wrong regime. If you are sitting in long-duration paper promises, while inflation pressure is rebuilding, if you are overexposed to assets that depend on a stable denominator, if your cash position is larger than your real liquidity need while the denominator weakens, then you are not just missing upside. You are financing your own irrelevance. That is a hard sentence. But it is true, and I want to say something equally important on the other side. Understanding the sequence does not mean turning yourself into a maniac. It does not mean leverage. It does not mean going all in on one narrative. It does not mean replacing one form of lazy indexing with one form of lazy apocalypse. Cosplay, it means building a structure that can survive and benefit from the waves as they move. That might mean owning some gold or commodity exposure before the crowd feels comfortable with it. It might mean recognizing that dollar strength during the panic phase is not the final chapter. It might mean owning hard assets or productive businesses with real-world scarcity before the repricing becomes obvious. It might mean keeping a measured allocation to fixed supply digital assets before the liquidity wave arrives there. And it definitely means asking whether your portfolio reflects the old world or the one now emerging. That is the central test, because most people will not lose money here by making one giant mistake. They will lose it by staying politely attached to a portfolio built for yesterday. Let me put it another way. If the fire is moving room to room in a known order, and you are standing calmly in room 1 because the walls have not collapsed yet. You are not being disciplined. You are being late. That is what this sequence helps you avoid. Now, I do not claim that every cycle is identical in timing. They are not. The lags can vary. The violence can vary. The amount of policy resistance can vary. Governments can pretend longer in some periods than others. Markets can overshoot and undershoot wildly along the way. But the broad order of movement exists because it is driven by incentives and constraints, not by television personalities. That is why I respect it. Incentives repeat. Constraints repeat. Politics repeats. And because those things repeat, money escapes through the crack in the same order. The average investor loves final answers. They want to know what to buy, when to buy it, and how much it will go up. I do not have much use for that craving. Final answers make people sloppy. I prefer sequence thinking because sequence thinking forces humility and precision. It asks, where are we in the order? What has already moved? What is likely next? If the math continues to deteriorate, where is my exposure missing? What part of my portfolio belongs to the old regime? What part belongs to the next one? Those are adult questions. Adult questions build wealth. Childish questions chase candles. I also want to say this clearly, the opportunity is not merely in owning the right assets. It is in owning them before the narrative becomes socially comfortable. Once every magazine, every wealth manager, every television panel, and every dinner guest agrees on what the sequence is. Much of the easy repricing has already occurred. The point of learning the order is not to sound smart after the move. It is to be in position before the wave arrives. That is where the real money is made. And it is also why these opportunities feel uncomfortable. Comfort is usually the market's way of telling you the repricing is already well underway. Discomfort is where the discount lives. A lot of people confuse stress with danger. Sometimes stress is just the fee you pay for getting there early. So if you ask me what this rare pattern really means, I would say it this way. It means the smoke detector already rang. It means the bond market math is worse than the average person understands. It means oil pressure is not a headline problem, but a system problem. It means the fiscal structure has lost flexibility before recession has fully arrived. It means the printing door is the only politically acceptable door left. It means money has already begun moving. First defensively, then opportunistically, and it means you still have time, but not infinite time, to rebuild your portfolio for the sequence instead of the fantasy that the old environment is coming back neatly. That is the honest conclusion. Not panic, not prophecy sequence. The people who win in these periods are not always the smartest. They are usually the ones most willing to accept that the map changed and then position accordingly while everyone else keeps insisting the old map should still work. That is what I would do. I would stop asking whether the event feels scary enough to justify action. I would ask which wave has already started, which wave is next, and whether my current holdings belong to the right side of the crack. Because once the sequence begins, denial is just another position, and it is almost always the worst one.